Good evening, ladies and gentlemen. On behalf of the board and the management of National Development Bank PLC, we warmly welcome all of you to the bank's Investor Forum to discuss the bank's and the group's financial performance for the year 2016. We released our results to the Colombo Stock Exchange on the 21st of February. Our investor webinar, the online webinar, was hosted on the 22nd of February. We also released our annual report to the Colombo Stock Exchange on the 6th of March. Right. So this year's report was themed Unlocking Our Potential to Unleash Yours. Today's Investor Forum also coincides with the release of our annual report. Presiding today's event at the head table are the Chairman of NDB, Mr. Ananda Athikorala, the Chief Executive Officer, Mr. Dimantha Seneviratne, the Group CFO, Mr. Faizan Osman, and representing NDB's Capital Market Cluster, the CEO of NDB Capital Holdings Limited, Mr. Vajra Kulathilaka. Well, ladies and gentlemen, the agenda for today's event would be the CEO taking you through the macroeconomic environment that prevailed during 2016 and how the same impacted the business of the bank. He might also touch on the performance of the bank at a macro level. He then will be followed by the group CFO, who will take you through in greater detail in the financial performance of the bank. Once the presentations are done, we will open the forum for questions and answers. So before we move on to the presentations, let me make a quick reminder on the investor docket that we have handed over to you. It contains an investor feedback form, which we please request you to fill, taking a couple of minutes, and hand back to us before you leave the event today. So with that reminder, I think it's now time to move on to the presentations. Let me now call upon our CEO, Mr. Dimantha Seneviratne. So over to you. Thank you.
Pointer. Okay. Good evening, ladies and gentlemen, and also my colleagues from the bank. I quickly go through the few slides about the macroeconomic situation and also how it has impacted the bank. So talking about NDB, roughly about 35 years in operation. It started as a development banking institution in 1979, and the bank moved on to commercial banking with the acquisition of ABN AMRO branches, the branch here, that was in 2001. So since then, from a development banking institution to commercial and corporate banking, and since of late we are launched into more on the retail and SME space, where now we have 105 branches. Of those, about 50% of those branches have been added to the network in the last 5 years, and about 35 branches in the last 3 years. So it's a transition from a development banking institution to commercial and now more on the retail side. That's where we stand. And about the bank's subsidiaries, NDB Capital Holdings is the one which is under which all the investment banking cluster is held. So NDB Investment Bank, NDB Wealth Management, NDB Stockbroker arm, and also the NDB Zephyr Partners, which is a fund management company. Plus we have overseas investment in terms of NDB Capital Bangladesh, and then Development Holding Private Limited, which is 58% with NDB and joint venture with EDB, where we had the property management company where our head office is also located. So just that's a overview of the bank and the group. And moving on to the macroeconomic and the industry overview last year. As we know, last year was a challenging year in terms of a global economy, where the global GDP came down drastically. Overall, only 3.1% in 2016. And that was actually even China. China had very low soft landing, and the world's largest trading nation posting lowest GDP in 26 years. So naturally, the impact, we being a smaller country involved in import and export trade, naturally, we also were impacted. And then the weak global demand that actually led to the slowdown in the trade. Talk about Sri Lankan economy, naturally, again, the GDP growth rate was one of the lowest, just around 5% in 2016. And there was a couple of policy changes that basically impacted the banking industry. One was at the beginning of the year, having started the year in 2016 with a 34% growth in credit to the private sector. 2016, there were policy rate decisions that took place. One major one was the increase in statutory reserve requirement from 6% to 7.5% to curb the credit growth. And during the year, we saw almost 250 basis point increase in the money market rate. So those had an impact because the signals from the regulator was to curb the credit growth. And that, of course, was happening in a slower pace than was expected by the regulator. So several times the interest rates were adjusted. And naturally, there is a lag effect, about 12 to 18 months in we seen the impact. And now only we see a reduction in the credit growth. So on top of that, the average inflation also last year was increased to around 4%, but now, as we are aware, it's now hovering around 6% or 6.5%. If you talk about the banking industry, the credit growth, overall industry credit growth, that of course declined to 17.5%, 21% in 2015, and deposit growth was 6.5%. We are talking about the industry where the total assets, the banking industry total assets is about 9 trillion. It crossed 9 trillion last year with a 12.5% growth. And in that industry, NDB, our asset portfolio is about 335 billion, which is about 3.8% of the market. The growth in 2016, NDB's growth was 8% compared to the industry growth of 12%. The total loan book, the industry, all the banking sector assets, 5.5 billion, the loan book, whereas NDB market share is 228 billion. So roughly about 4.2% in terms of market share. Total deposits, the industry total deposit is 6.2 trillion, which had a growth of 16.5% last year. NDB's growth was 10%. Overall deposit portfolio is 204 billion. So market share is 3.2%. So roughly what we have seen is that though the industry has grown on average around 15-16% in both advances and deposits, NDB as a bank, our growth was around 10% in deposits and 8% in advances. So that's one factor that you all notice when we assess the financial performance of the bank. Uh, Sorry. So, so this is the performance summary in terms of. Okay. Right. Okay. I'll cover the summary and then. I'll talk about the awards. Couple of awards. I think major one that we won last year was the CFA Sri Lanka's Capital Markets Gold Award for the Best Investor Relations. Previous year, 2015, we were awarded the Silver Award, and 2016, the Gold Award. One particular reason, of course, is we have been very open with the investors about our stand, and then we had our webinar and also the investor forums like this that has contributed to get this award. Similarly, a couple of other awards in Asian Banking and Finance Awards as the Domestic Retail Bank of the Year Sri Lanka, and also Iromani Awards that the awards are listed and also in the annual report. So these few awards that we won during 2016. And moving on to the performance summary, I will cover the performance summary, and thereafter CFO will cover more macro level explanations. The profitability, we had year-on-year growth of 8% in terms of operating income. So which is in line with the advances growth that we earlier spoke of, from 12 billion to 13.1 billion. And operating expenses also grew by about 7%. So in terms of income versus expenditure, it's positive jaws, 8% growth in income versus 7% growth in expenses. However, the profit after tax, that's actually 10% decline. Mainly two reasons. One was provisions in terms of NPA and also the precautionary provisions that we have taken. Other one is on the tax impact with additional value-added tax and the tax rates going up. So those were the two reasons which would be discussed later on. But there is a 10% decline at bank level. In terms of financial balance sheet, total assets, there was 8% growth from 309 billion to 335 billion. And loan book, 9%, 215 to 234. And deposits, 10% growth from 185 to 204. Bank had a historically high advances to deposit ratio because, as I mentioned earlier, starting from a development banking institution, where funding was mainly the lines, credit lines that we got. We have been shifting from that model to more own deposit growing model. So that's where right now our AD ratio is around 107, 108%. So that one target is to improve the AD ratio, bring it below 100%. So to self-fund our growth in advances. So that's why the investments in branch network has taken place. And usually there's about 1.5 to 2 year kind of period where the branch to get certain maturity and give their full, to reach its full potential in terms of growing the deposits. So that's what we are working on. In terms of efficiency, cost income ratio, that has improved from 49.5% to 49%. So below 50% cost income ratio, but still I think there's room for us to improve. The scale matters. but still I think moving on, we have to work further on this area, though we are on the industry average in terms of cost-income ratio, still we believe that there is room for us to improve. Net interest margin, that's where we were not as good as our competitors. We have managed to retain the net interest margin, which was 2.6% last year, this year as well 2.6%. But when you compare with the industry average of around 3.6, 3.7, we are 100 basis points below the industry. So that's one area where this year in our strategic plan we are working on. And also return on equity, again, that has deteriorated from 15.6% to 13.4%. Naturally, because the profit got declined, and also with the retained profit, the capital has gone up. This is again below par with the industry average. So again, an area for us to work on. Loan to deposit ratio, as I mentioned, it's now 114%. Actually, by now, this has improved to below 110%. And also capital adequacy, that has improved to 13%. And the liquidity ratio, that of course manage well above the 20% minimum required. So this is the summary of our performance for last year. A lot more to do in terms of improvement as compared to market. You would see that we are performing, I think compared to our potential, we are performing below our potential. So a couple of things to work on. One is on the developing our deposit base, especially in terms of low cost deposit base through CASA. Other one is on the cost side, and also on the improving the margin side, the repricing of our assets that we are working on. Apart from those simple areas, though they are simple, they're difficult to deliver, we are also working on our strategic plan. So right now, we are the entire corporate management team and the next level is involved in strategizing and looking at our current situation and then coming up with suggestions to see next 3 to 4 years come up with a good strategic plan to get the bank to the level that should be. So probably later on when there are questions and answer sessions, I will cover more on if there are specific questions on those. So with that, I leave it to Faizan to cover on the other detailed information about the financial performance.
Good evening, ladies and gentlemen. Thank you very much for coming in here today and taking time out from your busy schedule. And we appreciate that very much. Before starting my presentation, I just want to say the CEO showed us a slide on the awards, what NDB had got last year. This is what the outsiders tell about us. And amongst that, me coming from the finance world, it brings us immense proud and pleasure for NDB to have won the CFA Gold Award, which means we are the best in terms of investor relationships, engagement in the country. And that award is basically for disclosure, transparency, and timely information. We are the best in the country. We hold the goal. The challenge is to retain it. And I must tell you, in terms of the award, there's also increasing competition. It's a challenge to hold it. And increasing competition is also good for the capital markets, and I'm sure Wajira will be happy if the capital markets are improving. Anyway, my job today is to do a presentation to give a brief update of our 2016 performance so that I can set the pace and the stage for the CEO, chairman, and also we have Wajira in our head table So if you have any questions on the performance, on the strategy, on the future, you all can ask from them, because these numbers have already been discussed, published, so I won't spend a lot of time. So you already touched this slide. This is a very important slide. It's the snapshot. I call it helicopter view. If you want to see a town or an area, the best thing is you go into a helicopter and you have an aerial view. So it's this a similar position, an aerial view of NDB's performance for 2016, broken into 4 quadrants. Basically, the profitability, the financial position, which is from the balance sheet, which gives you the size, a few key efficiency ratios, and the business capacity ratios, which really indicates the agility which provides the bank to do further business in the future. Quickly, in terms of profitability, what you see is a decline of 10%. Prima facie, what you see is a decline of 10%. But you really need to go and see what these numbers are. 2016, as CEO said, it was a challenging year. NDB had its own challenges, come to that. But starting with the operating income, you see there's a growth of 8%. Now, operating income includes both NII and other income. What really happened here was the net interest income went up by 12%, but the other income, there was a marginal dip. And the other income came down basically because the income from trading, FX, they came down. So again, what it says is the core business did well. In terms of operating expenses, it has gone up by 7%. Given that inflation is 7%, we opened 11 new branches. I think we have managed costs well. Profits came down by 10%, but if you really go to the numbers, the real reason was that there was incremental impairment of around like 600 million, plus there was additional tax charges. We'll cover that in the detailed P&L. Financial position, which comes from the balance sheet, we see our total assets have grown up by 8%. Loans have grown up by 9%. Deposits have grown by 10%. So what you see is real growth. As CEO said, this is less than the market growth, but NDB has grown during 2006. Perhaps we could have done better here. In terms of efficiency and returns, we see our cost to income going down, which is good news. Net interest margin has remained flat. We'll come to that, why they are. And return on average equity is down. As I said, the profits were down by 10%. That is not the aspirational target we really wanted, but the reality is the ROE has come down to 13.4. And in terms of the business capacity ratios, loan to deposit ratios is down to 114, which is a good sign. Capital adequacy ratio remains strong at 13, and our liquidity position is over 20 and continues to remain strong. So this is a snapshot of NDB's performance. What you see is a 10% decline compared to last year, and the 10% decline is mainly because of one-off impairment provisions and higher taxes. But if you really go through the numbers, our core business has done well, and we have reported growth in 2016. Okay, now this is the detailed profit and loss account. So let me explain. It's a reconciliation. We started there is a dip of 9.7%, and last year we started with 3.5 billion. Towards the kitty, there's a contribution of 965 million in terms of NII. So you see there's a 12% growth. Now that growth could have been higher if not, we had higher funding costs in 2016. The NII actually grew by about like 35%, but the interest expenses rather grew at a higher pace. If not the interest expenses and the market conditions in 2016, we could have reported a higher growth. Other income came down by 0.5%. But again, there is a slide on other income. What you see is the core business, basically the LCs, the fees, that business grew. But the fee from trading, FX, revaluation, that was lower. Impairment. We had 655 million of additional impairment. Now this is one area where we got hit. Out of the 655 million, 589 million was for individual provision for one or two specific customers to a specific sector, and that individual impairment was done on internal decision based on prudence and internal risk management practices. Operating expenses went up by 6.6%, that's 399, and there was also additional tax of 228. So although we had less profits, we had to pay higher tax because, as you know, the FS-VAT rate went from 11 to 15%. So overall, what we see is a 9.7% dip in our profit after tax, 9.7% dip in profit after tax, and that's down mainly because of the impairment. Again, specific provisions and additional taxes. The core business at NII has done well. There's a growth of 12.8%. Other income shows a dip, but if you really go behind the numbers, the core business has done well, but the one-off incomes were lower compared to last year. The net interest income. In the previous slide, we saw a growth of 12.8 to be precise. So what we say is we had a growth of 13%. What really happened was that in the first quarter, we started revising our pricing based on the need on the market liquidity, our capital structure, and the internal requirements. We started revising our pricing custom assets. And that really paid off. You see in the second quarter, it went up to 18, 20. But again, on the fourth quarter, the NII came down because in 2016, you'll be aware, the interest rates, the T-bill interest rates went over 200 basis points. And bulk of the increases happened in the fourth quarter. So that's the story behind the net interest income. Sorry. Other income of 4.6 billion shows a dip of 0.5% compared to last year. But if you really go behind the numbers, this is the core business. Fee and commission, it has gone up by 12%. Where we fell short was on forex trading, the gains from financial investments, and the other operating income is basically the revaluation gains. Forex trading was less, is basically the swap positions from the customer and the interbanks. So if you really, again, if you really look at other income, it has come down because of the one-offs, which is really not within the bank's control. The core business has grown. And if you go by all the business sectors, projects finance, retail, and corporate, they all have contributed higher revenue in 2016. The next slide, operating expenses. Grew by 6.6. I don't know, I personally view that a 6.6, if you can curtail, that's fair enough. I think we had done well here, despite opening 11 new branches. We have recruited 149 new recruits to support the future growth of the business. In 2015, 2016, both years, we almost invested ₹1 billion on additional capex, mainly to support technology. This will bring incremental benefits. There was an inflation of about 4.5% in 2016. But despite that, you see our cost-to-income ratio has come down. And we actually did an acid test because the cost-to-income ratio is more linked to the revenue. We also calculated the cost-to-average assets. And here you see it's coming down from 2.12 to 2. So even if you look at from another angle, we can conclude that in 2016, we have managed costs better and been able to bring the costs down. From operating expenses, let me take you to the balance sheet. CEO explained that our portfolio size is around like 335 billion, and 2016 we saw a growth of around 8%. Perhaps the industry would have grown a bit higher. At these levels, at 335, we have a market share of around like 3.8 to 4%. We may have lost market share marginally in 2016. That's again because of our own balance sheet structure and the limitations we had in terms of liquidity and capital to expand our business. So you see the customer assets grew by 9%, the deposits grew by 10%. NDB's strategy the last few years, and is likely to continue that, to grow our deposit base at a higher pace than the assets. If you look at the balance sheet, around 30% of the balance sheet is in foreign currency. There is no major mismatches. The mismatch is basically 1 or 2 billion, which is covered through swaps. In terms of the assets, around 69% of the assets are customer loans, 69%. That's on the asset side. Now, on the liability side, it is funded by 60%. So there is a funding mismatch of around 8 to 9%. So it is because of this funding mismatch, we have a higher ADR of around 114. Because of this funding mismatch, we are actually dependent on external borrowings interbank. So in 2016, the rates went up. So if the rates went up, our margins got squeezed. So that's the story behind. But going forward, with our deposits increasing, we should be able to increase our margins. Loans and advances over the past 5 years, we have grown at a CAGR of 26%. Last year, we grew at 9%. That's because of our own internal pace, which, taking into account the capital, the liquidity constraints in the market, 2016 was more a year of consolidation. You also see, for the first time, our retail book going up from 39 to 41% of our book is retail. Corporate has basically from 38, it has come down to 33%. That's again, it's a cautious strategy taking into account the liquidity, the funding mismatches in the balance sheet, and the need to improve margins. We have been more retail focused. So there has been asset growth of around 9%, which is moderate, less than industry. We may have slightly lost market share, but that was again restricted because of our own internal needs to make sure that our margins are kept, taking into account our liquidity and capital. Asset quality. Last year, there was growth of 9%, which translates to almost 19 billion. So So we grew by 19 billion. But the NPL, what you see here is it's flat. So it's at 2.6, so it's a flat curve. Yes, we do recognize that the industry NPL has come down, but many of you all will know that one reason for industry NPL also to come down is that a few banks had large NPLs which were really classified or got corrected. But nevertheless, we have kept it at 2.6 despite a growth of 19 billion. And the other fact is also that we have been more retail focused in 2016. In terms of portfolio diversification, we don't have large concentration limits, concentrations to any particular sector. Our risk process ensures that portfolio is well diversified and there is concentration limits. The only sector which you have to exceed the limit is the agriculture. That's a regulatory requirement. You have to exceed 10, and we are slightly over 10 here. This textile and garment, it shows 8.1%. But if you really go behind the numbers, this sector is only 7%. There's nothing to worry. And in terms of the actual NPAs in this sector, actually it came down, but the exposure really went down. So when the exposure goes down, the ratio goes up. So there's nothing to worry here. Customer deposits, we grew at 10%. Now this is one of the key focus areas. She also said that, indicated that we are actually a relatively new bank. We started around like 38 years back as an apex body of the World Bank to channel development funding in this country, and it was somewhere in 2001 we took over ABN AMRO, and the real consolidation or going into commercial banking happened in 2005. So that means we've really been in banking only 12 years. So that's why you see our CASA ratio is at 23% compared to the industry average of over 35, or some banks have over 40. Now this 23% is actually affecting our margin, but how we see this 23% is we actually see it has a competitive advantage. And let me explain why. Because for a matured bank, when you're at 35 or 45, there is no further room to improve. They had to stay there, and they had to sustain, and they had to hold on. Because there is a level you can improve CASA, and you cannot go beyond. But we are a young bank, and from 23, we can look forward to take to 35 or 40. So just imagine if our CASA goes to 35, the entire margin structure has to change vastly. And that's why I said this, the lower CASA base, we see it has a competitive advantage. The CASA, the total deposit is 204, and for the first time we exceeded the 200 billion mark, which is another happy milestone. Okay, let me move to the capital adequacy. Currently, the capital requirement is 10%. We are well above that. We all know that from July 1st, the new Basel III rules come into effect, and the Pillar 1 will increase to 7.25 and total at 11.25. But even at this level, assuming that there is no major shift in the asset portfolio, we have adequate capital, assuming that there is no major shift in the RWA. So our capital position continues to remain strong. This is my final slide, and this is for you, the investors. Eventually it comes to these. And if you really get behind this, the earnings per share has come down, the ROE has come down. And that's because there was a 10% dip in the profits compared to last year. and that dip in profit was basically because of the high impairment of 600 million plus the higher taxes, coupled with our incremental funding cost in 2016. Hopefully that should not be there during the current year. And our performance in 2016 is not really what we aspired, and we are really not happy. But nevertheless, there is an earnings per share of 19 and ROE of 13, and we have paid a moderate or an affordable dividend of 8 compared to 11 last year. The good news is the book value has improved from 137 to 149. Although the share price has come down, the book value has gone up. The P ratio is low, and with the price to book value of 1 or lower, I think when we did this valuation, the closing price was 156. Am I right, Suendri? 156, and today is around like 130. Yeah, so the price to book value must be around like 0.8, so it's even low. So all what I can say is that NDB share at this moment looks very attractive. Well, thank you. With that, I'll hand over, open the forum for questions and answers from our CEO, our chairman, and also we have Wajira. Am I right? Yeah. Sorry? Next slide.
Ladies and gentlemen, it's now time for questions and answers. If you do have any questions, you may please raise your hand and indicate so. The staff from the hotel should provide you with a mic. Well, it seems like there aren't any questions from the audience.
All I can say is we are convinced with what you said. And I think this year has been challenging in several aspects, but with our new CEO on board, we are looking forward to taking on those challenges and looking forward to having a much better year ahead. So there may be certain regulatory things that need to be, somebody was asking me earlier on what the tax implications of all this is, but that's an issue that all banks will be faced with, and we have to find solutions once there is some more clarity on that. So if there's any other sort of general question even, or questions? Anything else? Vajra, maybe from a...
Okay, so in the absence of any questions, let's bring this forum to a close. Thank you, ladies and gentlemen, for being here today